The system is rigged against you, but only if you play by the old rules. Most people think credit scores are a mysterious black box controlled by some nameless, faceless algorithm designed to keep you in debt forever. They believe that if they miss a payment or max out a card, they are stuck in the penalty box for 7 years. That is a myth, and it is a myth that costs you tens of thousands of dollars in interest rates, insurance premiums, and lost opportunities. Today, I am going to show you exactly how to bypass the standard slow-motion approach to credit building and instead use a precision strategy to force your score upwards in record time. The reality of your credit score is that it is not a measure of your character. It is a mathematical model based on 5 specific data points. And if you understand the weights of those points, you can manipulate them like an engineer tuning a machine. 35% of your score is payment history, 30% is amounts owed, 15% is the length of your credit history, 10% is new credit, 10% is your credit mix. Most people fail because they focus on the wrong things. They obsess over the total number of accounts, or they try to pay off debt in a way that actually hurts their utilization ratio. Let us start with the single most powerful lever you have, which is also the most misunderstood: credit utilization. This is the ratio of your current debt to your total available credit limit. If you have a credit card with a $1,000 limit and you carry a balance of $900, your utilization is 90%. To the algorithm, this is a red flag. It screams that you are overextended and struggling to manage your cash flow. You could have a perfect record of on-time payments for a decade, but if you let your utilization hit 90%, your score will crater overnight. The secret here is not just keeping your balance under 30%. That is the bare minimum for average people. If you want to see rapid, significant movement, you need to treat your credit card like a debit card. The hack that top-tier financial players use is what I call the statement cycle reset. Most banks report your balance to the credit bureaus on your statement closing date, not your payment due date. This means that if you make a purchase on the 25th of the month and your statement closes on the 30th, that transaction will be reported as part of your balance, even if you pay it off in full on the 15th of the following month. To trick the system into reporting a near zero balance, you must pay off your credit card balance in full 2 or 3 days before your statement closing date. When the bank reports to the bureaus, they see $0 owed, your utilization drops, and your score spikes, sometimes within a single billing cycle. You are essentially hiding your usage from the reporting agencies while still maintaining the convenience and rewards of using a credit card. Now, consider the authorized user strategy. This is perhaps the fastest way to add positive weight to your credit profile if you are starting from zero or recovering from a low score. You find a family member or a trusted friend who has a long history of perfect payments and low utilization on their credit cards. You ask them to add you as an authorized user. You don't even need to touch their card. You don't need to know their PIN. The moment they add you, their positive account history is mirrored onto your credit report. If they've had that account for 10 years with perfect payments, you suddenly inherit that 10-year history. Your average age of accounts rises, your payment history improves, and your score jumps. It's legal, it's effective, and it's a standard practice that the credit bureaus fully recognize. However, you must be careful here. You only do this with someone whose financial habits are impeccable. If you attach your credit profile to someone who starts missing payments or maxing out their cards, their bad habits will bleed into your report immediately. This is not for everyone, but for those who have a strong network, it's a shortcut that can save you years of slow, steady climbing. Next, you need to address the errors that are likely already dragging you down. 1 in 5 credit reports contains a significant error. These are not just small typos. We're talking about accounts you never opened, late payments for debts you already paid off, or closed accounts still showing as open and active. You have to be proactive. Pull your official reports from the 3 major bureaus. Don't rely on the apps that give you a rough estimate. Go to the source. Scan every single line. If you find anything that is not 100% accurate, you file a dispute. The law requires these agencies to investigate your claim within 30 days. If they can't verify the negative information, they are legally required to remove it. Every time a negative mark is removed, your score recovers as if that mark never existed. Now, let's talk about the long game, because shortcuts only get you so far if you don't have a foundation. The length of your credit history matters. This is why you should never close your oldest credit cards, even if you never use them. That card is your bridge to the past. It shows the bureaus that you have been a participant in the financial system for a long time. If you have an old card with no annual fee, put a small recurring expense on it, like a subscription service, and set it to autopay. This keeps the account active and prevents the issuer from closing it due to inactivity. Every month that card stays open, your average age of accounts grows, which makes you appear more stable and less risky to lenders. Stability is the name of the game. When you apply for new credit, you trigger what is called a hard inquiry. This is a temporary ding to your score, and it signals to lenders that you might be hungry for cash. Don't go on an application spree. Every time you get a denial, it hurts. Every time you get an approval, it's a small hit. Be strategic. Only apply for the credit you truly need, and only when your utilization and payment history are in the best possible shape. This is how you maintain a high score that opens doors to lower interest rates on mortgages, car loans, and business financing. Remember that a credit score is simply a reflection of risk. Your entire goal is to convince the bank that lending you money is the safest decision they can make today. You do this by automating your life. Use AutoPay for every single bill, not just credit cards. Utilities, rent, and subscriptions all count. If you're struggling to stay organized, use a single account to consolidate your payments so you never miss a deadline. A single late payment can wipe out months of progress. It's not worth the risk. Finally, understand the difference between revolving credit and installment credit. Revolving credit is your credit cards. Installment credit is your loans. A healthy profile has a mix of both. Don't feel pressured to take out a loan you don't need just to fix your credit, but understand that having a diverse set of accounts shows you can manage different types of financial obligations. If you are already carrying a small loan or a car payment, stay consistent. That steady, predictable payment schedule is exactly what the algorithm is looking for. You have the power to change your financial trajectory. It doesn't require a higher income, and it doesn't require waiting for years. It requires a ruthless, logical approach to your numbers. It's about understanding the system, exploiting the gaps, and maintaining the discipline to keep your utilization low and your payments on time. Start today by auditing your current standing, disputing the inaccuracies, and resetting your utilization. Your future self will look back at this as the moment you took control of your credit, and by extension, your financial freedom. The system is just a set of instructions. Learn the instructions, follow the logic, and you'll see the results on your statement every single month.